Most investors will lose money on Monday morning, not because they were wrong, but because they were waiting. Let me tell you something uncomfortable. On Friday afternoon, the market closed peacefully. Screens went still, portfolios looked stable, nothing appeared urgent. But over the weekend, the world moved. Information shifted, risk recalculated itself, and somewhere beyond the trading hours of major exchanges, price discovery continued, without the majority of retail investors participating. Here's the paradox no one explains clearly. When markets are closed during a crisis, the real repricing often happens while you cannot trade. And when the market finally reopens, most people think the opportunity is just beginning, when in fact, it may already be halfway done. That's why Monday's open can feel violent, not because the event is new, but because the price is catching up to a reality that already changed. Tonight, I'm going to break down the exact mechanism behind that shift, calmly, logically, without panic, so you understand what is happening before the bell rings, not after it shocks you. Now let's slow this down and look at what actually happens in moments like this. Imagine it's late Sunday night. You open your trading app out of habit. The numbers are the same as they were on Friday. Gold closed there. Silver closed there. Your portfolio value hasn't changed. It feels stable. But stability on a frozen screen is not the same thing as stability in the real world. Over the weekend, institutions don't stop thinking. Risk managers don't stop recalculating. Hedge funds don't wait politely for the opening bell to adjust their exposure models. Central banks don't pause their internal discussions because retail investors can't click a button. When something significant happens, geopolitics, energy risk, currency stress, liquidity concerns, capital begins repositioning conceptually before it can reposition mechanically. That distinction is critical, because markets are not just charts. Markets are collective expectations about the future. And expectations can change instantly, even if transactions are temporarily paused. Here is where the hidden shift begins. When traditional exchanges close, price discovery doesn't disappear. It fragments. It moves into alternative venues. It shows up in futures that open earlier in certain regions. It appears in currency markets. It surfaces in physical dealer premiums. It leaks into interbank spreads. In other words, the world keeps negotiating price, just not in the place most retail investors are looking. And that creates a gap between what you see and what is actually happening. On Friday, the official closing price reflects the consensus of that moment in time. But if major information arrives after the close, that price becomes a historical artifact. It represents a world that may no longer exist. Yet psychologically, investors anchor to it. That anchoring is dangerous. Because when Monday arrives, the market does not ask whether you are emotionally prepared for a new number. It simply prints it, and if that number is significantly higher or lower, the reaction most people have is not strategic. It is emotional. They feel late. They feel urgency. They feel they must act immediately to avoid missing it. But here's the deeper irony. The biggest losses in volatile openings rarely come from being uninformed. They come from misunderstanding how price adjustment works. When markets reopen after a shock, liquidity is thinner. Market makers widen spreads to protect themselves against uncertainty. Sellers hesitate. Buyers compete. Algorithms execute pre-programmed triggers based on technical levels that were already close to breaking. The opening print is not a gentle negotiation. It is often a compressed release of 2 days of suppressed repricing. That's why it can look violent, not because chaos is random, but because adjustment is delayed. And delayed adjustment is rarely smooth. Now let's address the subtle but important paradox in all of this. People believe that waiting for confirmation reduces risk. But in environments like this, waiting can shift you from proactive to reactive. If the underlying thesis for holding metals or hedging risk was already built on structural instability, then a weekend escalation doesn't create the thesis, it accelerates it. So by the time the market opens, the debate is no longer, is this real? The debate becomes, how far has it already moved without me? That is the psychological trap. And it is amplified by one more factor most people overlook. The price at the open is not just information, it is a signal. It tells institutions how the collective market has chosen to interpret the weekend. It triggers systematic funds. It influences margin requirements. It alters risk models across portfolios globally. So what you see at 9:30 a.m. is not simply a number. It is a recalibration point for capital flows. That's why preparation matters more than prediction. Because if you understand that repricing can occur while markets are officially closed, then you stop asking, what will happen Monday? And you start asking, what will I do if Monday confirms that the world has already shifted? That shift in thinking is the difference between reacting to volatility and navigating it. And in the next section, we're going to break down exactly how gap openings form, what typically happens in the first hour of trading, and why liquidity behavior, not headlines, determines whether that move extends or retraces. Now let's go deeper into the mechanics, because once you remove emotion, what remains is structure, and structure is what protects capital. When a market reopens after a significant weekend shock, the first thing you need to understand is this. There is no such thing as a normal open in abnormal conditions. The opening price is discovered through an auction process. Orders that were placed before the bell, buy orders, sell orders, institutional hedges, algorithmic triggers, all meet at once. The exchange calculates the price that clears the maximum volume. If sentiment shifted dramatically over the weekend, the imbalance between buyers and sellers becomes obvious immediately. More buyers than sellers? The price must move up to attract sellers. More sellers than buyers? The price must move down to attract buyers. That movement between Friday's close and Monday's open is the gap. But here's what most people misunderstand. The gap itself is not the trade. The environment after the gap is the trade. Because once that new price is printed, three forces collide in the first hour. First, liquidity providers. Market makers widen spreads during uncertainty. If gold closed at one level on Friday, but alternative signals suggest a higher valuation, market makers will quote cautiously. Bid-ask spreads expand. Depth of order book shrinks. That means price can move faster on smaller orders. Second, systematic flows. Large funds do not think the way retail traders do. They follow models. If certain technical thresholds are breached, prior highs, breakout levels, volatility bands, algorithms activate automatically. If metals were already near breakout territory on Friday, a strong gap can push them decisively through those levels. That activation can add fuel quickly. Third, human psychology. Retail traders open their apps and see a move that already happened. Some panic buy to avoid missing further upside. Others hesitate, waiting for a pullback that may not come immediately. Short sellers, if they exist in size, may be forced to cover. This cluster of reactions compresses time. What might normally unfold over several sessions can occur within hours. Now here's the crucial insight. Gap openings do not guarantee continuation, but they do guarantee instability. Because after a large repricing, the market needs to test itself. It needs to discover whether the new level has genuine support or whether it overshot on thin liquidity. That's why the first hour is rarely the whole story. Sometimes you see immediate continuation, strong open, shallow pullback, steady grind higher. That pattern suggests institutional alignment. Other times you see sharp volatility, surge higher, aggressive reversal, wide intraday swings. That suggests disagreement and unstable conviction. Understanding which environment you are in is more important than predicting the exact number. And here is where discipline separates strategy from impulse. If you plan to allocate gradually into metals as a hedge, a gap does not invalidate that plan. It simply changes the execution. If you plan to trade short-term momentum, you must respect volatility expansion and size accordingly. But if you had no plan, the open will feel like chaos, because chaos is simply structured movement that you did not prepare for. Let's talk specifically about metals. Gold tends to respond first to systemic fear because it is the primary monetary hedge. Silver often amplifies percentage moves because of its smaller market size and dual industrial role. If the gold-silver ratio was already compressing before the weekend, a shock can accelerate that compression. But if gold gaps sharply while silver lags initially, that divergence can create short-term volatility as traders rebalance between the two. The key is not the headline number. The key is liquidity behavior. Are bids stepping up consistently on pullbacks? Are sellers aggressive into strength? Are spreads narrowing as the session progresses? These microsignals tell you whether the move has institutional sponsorship or is primarily emotional. And here's another layer many overlook: margin dynamics. In fast markets, exchanges can raise margin requirements. Brokers can tighten leverage. That forces some participants to reduce exposure, even if they are fundamentally bullish. That mechanical selling can create sudden intraday dips that confuse retail traders into thinking the move is over. Often it isn't. It's simply the market flushing weak hands to stabilize structure. This is why preparation matters more than speed. If your strategy depends on perfect timing in the first 5 minutes, you are competing against algorithms and institutions designed to operate in that exact environment. If your strategy is based on allocation, risk management, and thesis validation, then volatility becomes information, not threat. And that brings us to the most important question for Monday morning. Not where will gold open, but what does the opening structure tell us about capital conviction? Because a market that gaps and holds is different from a market that gaps and collapses. A market that gaps and consolidates tightly signals absorption and confidence. A market that gaps and whipsaws violently signals uncertainty and distribution. Those distinctions only become clear if you are observing calmly instead of reacting impulsively. And in moments like this, the investors who survive, and often thrive, are not the fastest. They are the most prepared. In the next section, we'll step back from the intraday mechanics and examine the broader structural implications. What this kind of repricing means for the medium-term outlook of gold, silver, and portfolio positioning. Because short-term volatility is loud, but structural shifts are where real wealth is preserved. Now let's step back, because while everyone is focused on Monday's open, the more important question is what kind of environment produces these violent repricings in the first place. Short-term volatility is loud. Structural shifts are quiet, until they're not. When gold or silver gap after a geopolitical shock, most commentary stays at the surface level. War headlines, fear spikes, safe haven flows. But metals don't sustain multi-month repricings purely on fear. They sustain repricings when trust begins to fracture. Trust in what? Trust in stability. Trust in monetary policy. Trust in liquidity. Trust that institutions can manage escalation without unintended consequences. When that trust weakens, capital does not disappear. It relocates. Gold historically functions as a confidence barometer. When investors believe the system is stable, gold competes poorly against risk assets. When confidence erodes, even gradually, gold becomes a hedge against systemic uncertainty. Silver is more complex. It sits at the intersection of monetary hedge and industrial demand. That dual identity makes it more volatile. In expansionary cycles, industrial demand supports it. In crisis cycles, monetary demand amplifies it. So when we analyze a weekend repricing event, the real question is not whether gold hit a specific number. The real question is whether this event reinforces a broader structural narrative. Let's consider a few structural forces that were already in motion before any weekend escalation. First, persistent inflation pressures. Even if headline inflation cools periodically, structural drivers, energy costs, supply chain fragmentation, fiscal deficits, do not disappear quickly. Central banks are constrained. If they ease too soon, inflation resurfaces. If they tighten too aggressively, credit markets strain. Second, global geopolitical fragmentation. The world is less economically unified than it was a decade ago. Strategic competition between major powers has increased. Trade routes are politicized. Currency alliances are shifting. Third, sovereign debt levels. Public balance sheets across major economies remain stretched. High debt environments historically reduce policy flexibility. None of those forces were created over the weekend, but shocks accelerate perception, and perception is what moves capital. If investors begin to believe that geopolitical escalation is not a temporary flare-up, but part of a longer pattern of instability, capital flows into defensive assets can become more persistent rather than episodic. That is how short-term spikes transition into medium-term trends. Now let's bring this back to portfolio construction. A common mistake investors make is treating metals as either a speculative trade or a doomsday bet. In reality, their most rational role is as portfolio insurance. Insurance feels unnecessary when conditions are calm. But insurance is not purchased because you expect disaster tomorrow. It is purchased because uncertainty exists in the system. If structural uncertainty is rising, whether through geopolitical fragmentation, monetary constraints, or energy disruptions, then the argument for a measured allocation strengthens. Notice the word measured. Violent gap openings can tempt investors into extreme positioning. That is rarely wise. Discipline matters more than intensity. If metals rally sharply on Monday and hold gains, that signals institutional acceptance of higher valuation. If they spike and retrace aggressively, that signals the move was more emotional than structural. Either outcome provides information, but information must be filtered through your strategy. Ask yourself, are you holding metals as a short-term trade based on momentum, or are you holding them as a hedge within a diversified allocation? If it is the first, volatility is your opportunity and your risk. If it is the second, volatility is noise around a thesis. Now let's talk about silver specifically, because silver's structural dynamics often get oversimplified. Silver's supply chain is tighter than gold's. It is mined largely as a byproduct of other metals, which means supply is less responsive to price in the short term. At the same time, industrial uses, especially in electronics, renewable energy, and high-precision systems, continue to expand. In an environment of geopolitical stress, defense production can also increase demand for specialized materials. That does not automatically create shortages, but it tightens margins. So if safe haven flows into silver coincide with persistent industrial demand, price volatility can intensify. However, silver's volatility cuts both ways. It can outperform dramatically in strong cycles. It can correct more aggressively in unstable ones. That's why position sizing matters. No asset should dominate your portfolio simply because headlines are dramatic. The discipline of allocation protects you from your own emotional reactions. Now let's zoom out even further. Financial history shows a recurring pattern. Periods of complacency are followed by shocks. Shocks are followed by repricing. Repricing is followed by narrative adjustment. The market first reacts mechanically. Then analysts construct explanations. Then policymakers respond. Then capital adjusts again. We are potentially in the mechanical reaction phase. Monday's open is part of that mechanical reaction. But what follows in the coming weeks, policy statements, diplomatic developments, energy price stabilization or escalation, will determine whether this repricing extends or stabilizes. And this is where patience becomes a competitive advantage. You do not need to predict the full arc of events tonight. You need to remain solvent, rational, and positioned according to your risk tolerance. Because wealth is rarely built in a single session. It is preserved and compounded by consistency. If structural uncertainty continues, metals may trend. If tensions cool, volatility may compress. But in either case, clarity beats panic. So as we approach the opening bell, remember this. The price is not the story. The structure behind the price is the story. Understand the structure, liquidity, conviction, allocation, macro backdrop, and the number becomes context, not shock. In the final section, we'll translate everything into a clear action framework, what to monitor in the first hour, what to ignore, and how to position yourself for both continuation and reversal scenarios. Now let's bring everything together, because information without a framework creates anxiety. Information with a framework creates clarity. As we move toward the opening bell, you don't need predictions. You need rules. So here is a simple action framework for Monday morning. First, observe before acting. The first 15 to 30 minutes after a significant gap are often unstable. Spreads are wider, order flow is imbalanced, emotional participation is elevated. Instead of reacting to the first print, watch how price behaves after the initial surge. Does it hold above the opening range? Does it retrace aggressively? Does volume expand on pullbacks or only on spikes? That tells you whether institutions are supporting the move, or whether it was primarily a liquidity vacuum. Second, respect volatility expansion. In stressed environments, intraday swings become larger. If you normally size positions based on calm conditions, adjust expectations. Wider ranges require smaller size if you want to control risk. Volatility is not your enemy, but unmanaged volatility is. Third, separate thesis from timing. If your thesis for holding metals is structural, inflation pressure, geopolitical fragmentation, monetary constraints, then one volatile session does not invalidate that thesis. But if your participation is tactical, your timing must align with confirmation, not emotion. There is a difference between buying strength that holds and chasing strength that fades. Fourth, monitor cross-market signals. Metals rarely move in isolation. Watch the US dollar, watch treasury yields, watch energy prices, watch equity index futures. If gold gaps higher while the dollar weakens and yields fall, that alignment supports the move. If gold gaps higher while yields spike and the dollar strengthens, divergence may signal instability. Markets speak in relationships, not headlines. Fifth, accept that you cannot capture every move. One of the most damaging beliefs in investing is the idea that you must participate in every rally. You don't. Missing part of a move is not a failure. Entering recklessly because you fear missing out often is. Discipline compounds. Impulse erodes. Now let's address two possible scenarios. Scenario 1. The market gaps higher and continues climbing with shallow pullbacks and strong volume. That suggests institutional conviction. In that case, strategic scaling, rather than all-in positioning, can help you participate without overexposure. Scenario 2. The market gaps higher, then reverses sharply and closes near the open or below. That suggests emotional excess was absorbed and rejected. In that case, patience often becomes the better strategy. Both outcomes are possible. Your job is not to predict which one will occur. Your job is to respond consistently to whichever one unfolds. And here's the most important mindset shift. Monday's open is not a referendum on your intelligence. It is a referendum on your preparation. If you have defined your risk tolerance, your allocation targets, and your response plan in advance, the opening print becomes information, not shock. If you haven't, the market will force decisions upon you in real time. That is where losses compound. Now let me leave you with something grounded. Gold and silver are not magical assets. They are tools. Tools for diversification. Tools for hedging systemic uncertainty. Tools for managing portfolio correlation. They should fit into a broader strategy, not replace one. If structural instability persists, metals can act as ballast. If tensions cool and risk appetite returns, they may consolidate. Neither outcome changes the core principle. Wealth preservation depends more on behavior than prediction. The investors who endure volatile periods are not those who guessed every headline correctly. They are those who controlled leverage, sized appropriately, avoided emotional overreaction, and stayed aligned with a coherent plan. So when the bell rings, remember, watch the structure, respect volatility, follow your rules, ignore the noise. The market may be loud on Monday morning. You don't have to be. If this breakdown helped you approach the open with more clarity and less anxiety, subscribe to Financial Future Map. This channel exists to give you a long-term framework, not just headlines. We analyze economic shifts, monetary policy, geopolitical risk, and market structure, so you can build your own financial map with confidence. If you want consistent, structured insights into the forces shaping the global economy, not panic, not hype, make sure you're subscribed and turn on notifications. Because in fast-moving markets, clarity is an edge. Until next time, prepare, don't panic.